So, James, welcome to the podcast. How have you been?
I'm doing good. Thank you for having me. I'm excited to be here.
I am so excited to have you here. We worked together briefly in the Gosel Fund, which is like the university investment fund, Lancaster University. And it was so nice to work with you. You're so knowledgeable and so kind. I'm very happy to you accepted my invitation.
It's my pleasure. No, it was a brilliant time working together in Gosel. We did some good stuff.
So, why don't you introduce yourself, James?
Yeah, so I'm James. I'm currently a master's student at Lancaster. I'm studying my master's in investment management. I did my bachelor's in accounting and finance, so I know a little bit about accounting as well. Met Alex through the Gosel Fund, and that's why we're here today.
hmm Awesome. Thank you. So, this interview is going to be focused on accounting and audit, in the basis that audit is about assurance, so about providing confidence in in financial statements, whether something is true or not. But in many cases, that truth might be partial, because the evidence might be incomplete. So we were going to be talking about it a little bit today. So first things first, James, please help us. What is audit?
Yeah, so I just to add to my little introduction, I did a summer internship with KPMG in audit, and I'm going to go and be a graduate with PwC in audit. So I know a little bit. And basically, at the high level, audit is about giving a reasonable assurance that a company's financial statements don't contain any material misstatements or anything like that. And the key word there is that it's reasonable assurance. So it's not a guarantee by any means. It's just a judgment call based on the evidence that they've reviewed, like you say. And I think that a lot of people imagine audit as just like a checklist sort of exercise where you're ticking a box, say it's a pass or a fail. But actually, in practice, there's a lot of uncertainty that comes into it, where it comes to things like asset valuations or provisions or going concern judgments like that. So it's not a black or white kind of thing.
That is a very good segue to my second question, because a lot of people think that it's exactly like that, a checklist where it's kind of a supervisor, and the supervisor is kind of checking that everything is in place and in order, and if you don't pass, it's just a fail and come back next year. But in reality, it's very much rooted in judgment under uncertainty. So I guess my question is, how much of that of the audit process is based on your own judgment, and how much is like following a book?
Yeah, it's a really, really good question. I think a lot more than you would think is judgment based. There is the framework out there, like you talk about, with all the rules, but like most rules, when you read between the lines, there's a lot of grey areas in there where you can exploit things to your own advantage, maybe. You can use them in a creative way. So auditors don't just check that the companies are following the rules as they're written, but they also need to check that they're not using the grey areas to portray something which actually isn't the economic reality of what's happening.
Mhm.
So if you think about something like forecasts, for example, how would you audit something like a forecast? Because it isn't an exercise where you can just tick a box. You
Mhm.
have to use what auditors call professional skepticism, where you look at it as if it could mean absolutely anything, where you're able to evaluate the assumptions used are reasonable. So
Mhm.
with something like this, different people could have the same facts and come to different conclusions just based on how they interpret it. You know what I mean?
Mhm. That is very, very interesting, because we are kind of used to technology growing at a super fast rate. But with companies like Nvidia, it is just crazy. It is almost hard to believe. Um, so what do you do in those cases where the technological advancement is so like nothing that we've seen before, to make sure this is like reasonable?
Mm-hmm. It's a tough one because
Mhm.
as a profession, audit is definitely evolving, but I'd say it evolves at a slightly slower rate than most things because the way the audit framework works is it has to apply to every company. There's not like a specific
Wow.
framework, like some for tech, some for, I don't know, a clothes retailer or something like that. So it's not a one size fits all approach. So everyone's got to consider the potential outcomes of issuing new legislation or new regulation, sorry, because it's going to affect everybody. So you'll see if you look at accounting standards that a lot of them were designed in the 20th century, and now we're set with a bunch of new risks in the 21st century with all these new things like tech and AI and all of that stuff. There is progress, and every year you'll see that there's updates and stuff to the standards.
Um, I remember I went to a audit talk the other day, and then the lady giving the talk, she was saying how hard they find to audit ESG, because they say, oh, we have reduced our carbon emission by 55% in the last 2 years. How do you know that? There is no real way for an auditor to give you the thumbs up.
Yeah, no,
So that's
definitely. It's everyone's using different metrics. There's no standard procedure out there. Everyone's got different technology for measuring it. The way of measuring it hasn't like been standardized in any way. It's such a difficult area, but it's growing so fast, and there's so many more experts joining the industry, every day.
maybe that is also a good segue to my next question, which is, so uncertainty premium is like the additional premium that you get for taking more risk. Do you think there is a concept like that in audit?
Uncertainty premium. That's a really good question. I think there's got to be an uncertainty premium because if you were to analyze a really complex business like a cryptocurrency exchange or a hedge fund that uses its own algorithm to or an AI to trade and follow signals and things like that, you'd need more time to understand it. You'd need a lot more time to test it, and you'd have to get specialists from the industry involved to actually help you dissect the evidence and stuff that they're giving you. And that's obviously going to increase audit fees because people who are specializing in something aren't cheap. The time itself is going to cost money. So there's a premium in that sort of aspect. And think about it, there's also a reputational sort of premium where audit firms take on a risk when they're signing things off on like uncertain areas, and that's going to in turn reflect the fees that the fees that the client has to pay.
Mhm. So what happens if the audit get it wrong, like in Supermicro?
Ah,
For
yeah.
example, for some context, I used to be, by the way, a very big fan of a company called Supermicro. They design hardware for AI, basically, and cloud computing. And at that time, and by the way, accounting, the overall concept, it is a steep learning curve in my experience. So they looked like a very nice, profitable, growing, dynamic company. But a lot of people told me that their account receivables are way inflated. And there was no way for me. Like it looked fine for me. But I guess they had the thumbs up from their audit team. What do you think happened there?
It's difficult without actually being involved in the audit, but with things like this, there's always a way for firms to exploit the rules, and auditors don't always get that. We've seen scandals happen throughout time, billions and billions of pounds worth of scandals. Like it is something that happens because there can potentially be sort of a two-way trust there where the the auditor also trusts the company, the figures that they're giving them are right, and the due diligence isn't the sort of standard as you'd want to see. And with a company like Supermicro, it's so big, so complex, it's things are bound to get lost when it's just people checking it.
Well, their firm, I think it was EY, just quit. So
Mm.
I guess it was a matter of time. And when it comes to like risks like that, I'm sure that is not nothing new, have been happening for a long time. But I think in an environment like what we have now of tariff uncertainty, um, companies are in a lot of pressure to, maintain performance, because there's a lot of volatility outside and the market punishes that very rapidly. So I will say there's more room for crazy stuff, crazy accounting thing to
Mhm.
happen, like firms inflating their inventories to reduce cost of goods sold. Do you think that this will be the case in like the near term?
It's a really, really important thing that you have to consider. And yeah, with the added uncertainty and the added pressures in the market right now, there is the incentive, for companies to push the boundaries on the rules. And it can happen for a lot of reasons, but we know with the all the market turbulence in the USA and things like that, it's a time where companies will want to hit their EPS targets, even though the market's suffering. And this might be for a number of reasons, just to show that they're doing well, or it might be linked to the CEO's remuneration package, and he wants the accountants to meet the EPS targets, and they can do that through all sorts of different ways. But this is going to boost their short-term profits, probably at the expense of their longer-term profits.
Mm.
So the auditors there are going to have to dig deeper and actually understand if they've changed any of their accounting rules for whatever reason, and see what's actually happening behind the numbers, and then be able to sign off on that.
That's crazy. So basically, a lot of people, would you agree? This is more like finance related. Do you agree that the market is very much short term focused? Because you're saying
Yeah,
um they are sacrificing long-term gains for short-term benefits, even though, on the long term, that's not ideal. But you might argue that this is because the market is going to punish them. So do you agree? And why do you think that is?
I'd say the market definitely is short term because human nature is to want to get a result fast for whatever you're doing almost. So if an investor's going to put money, they're going to want to see it more quickly a majority of the time. It's much less useful to say, oh, I'm going to make the shareholders happy in 5 years' time,
Mhm.
because who knows what can happen between now and 5 years away.
So in audit, how much of your work do you think is like backward looking versus forward looking?
Well, I've always thought that my predisposition of audit is that it was completely backwards looking. And yeah, auditing itself, that you're looking at the past year and just evaluating it off of that and just saying, yeah, this is right, this is wrong. But a surprising amount of it is actually looking at the future. So just from very basic assumptions, you've got to go off the going concern assessments where you'll account for things differently based on whether the firm's going to shut down in the near term or if it's going to keep operating. And who actually knows what's going to happen, if this company is going to keep operating. So that relies on someone's judgment, forward looking. And a lot of accounting relies on forecasting and things like that, like we talked about before. And the question that's always being asked there is whether the assumptions about the future are realistic or if they're too optimistic, and things like provisions. So you'll have a provision for doubtful debts where you say, oh, I think 5% of our customers aren't going to pay their credits to us. So who comes up with that 5%? And you're going to carry that 5% through the account. So it's an interesting one.
Hmm. It kind of reminds me of a quote I heard someone say the other day. They said, you have to, right now, with so much uncertainty going on, you have to ignore the noise, but keep in mind the signals, which is, it sounds simple in the surface because, okay, there is a lot going on that might or might not be applicable in a few hours from now. So there are a lot of moving pieces at the moment, which could be noise. And this applies from an audit and accounting perspective and an investor's perspective. Let's take Tesla as an example. If the board of directors and investors are demanding Elon to go back to do what he has to do as the CEO of the company, and he keeps refusing, and that brings a ton of volatility to the stock. If he spends a day at the company, the stock increases by 25%, and same the other way around when he goes and has an argument at the White House. How much do you think that is just noise of like Elon just like, I don't know, doing whatever he's doing versus a signal that that is a failing company?
I think most of it is noise. I like that quote that you said before about, it did ignoring the noise and focusing on the signals. That's really interesting because there's a lot of behavioral biases that go into, the decisions that you're making, like that are inherent in human nature. But with the Elon stock price booming when he's in the office and things like that, how much of an impact can he actually make with a couple of days in the office? It seems to be more of a bandwagon that people are hopping on to, which doesn't have much validity in it.
But how are you sure that that is not a fundamental, that is not a signal of a fundamental failure in the management structure of Tesla as a company?
Elon is just such a public figure that everything he does is under so much scrutiny, and he is the face of Tesla. I
Mhm.
couldn't name you a single other person involved in Tesla apart from Elon. So everyone's going to be looking at him, and all of his actions are going to be a portrayal of what people think is happening in Tesla.
Mhm.
So it's a signal in that sense that people are looking at him as the face. But I'd say the noise is the fact that the claims of him being in the office and things like that, they don't have much substance behind them.
Okay, so to conclude the point, which I think is a very valid point, what do you think is the difference between noise and signal then?
I would say obviously a signal is much longer term in view than the noise is. So I think a signal can be seen in a lot of different ways. Like
Mhm.
opening a new factory, I'd say that's a signal because that's signaling to the market that they're confident as a company, they're looking to grow and things like that. But Elon being in the office, that's not really a signal. That's just him turning up to work one day.
And do you think the market often trades on signal or noise?
Depends on the investor, but it's an interesting point. Yeah, I think most retail investors will be trading on noise. They'll be trading on an article that they've seen in the news. But people who follow their investing will be looking for the signals and will be able to see the value in different things, if you know what I mean.
Mhm. Let's go to the last part of this podcast, which I like to call Help Me Think. This is basically a piece of news that I find interesting, and I would like to kind of you help me digest what it really means. So recently, the US is preparing to make substantial cuts to banks' capital requirements. Basically, they don't need to hold as much money liquid, particularly in treasuries. So basically, these might help them boost the demand for treasuries. And on the other hand, Moody's recently downgraded the US credit rating for the first time, I would say, since like, I don't know how long, but a long time. Do you think this is a push by the government to like increase liquidity in the treasury market, but like a hard push?
It's interesting. The obviously cut in capital requirements and then the downgrade in Moody's, they seem to be working hand in hand. So it definitely looks like they are trying to boost liquidity in the treasury market. But from my understanding, banks need to set aside some capital when they're holding these treasuries, even though they're low risk. Would you say that's right?
Mm-hmm.
And then,
Want to like
okay,
get rid of that.
yeah. So that makes banks not want to hold and trade these treasuries,
Mm-hmm.
especially during the periods of market stress because they need the liquidity themselves.
Mm-hmm.
So by lowering the capital requirements that banks need to hold against the treasuries, it's going to, in essence, cut the amount that they need to hold and will encourage them to buy more treasuries and then improve liquidity when it's needed most, like in times like this. Now, the Moody's downgrade adds a complicating layer. So we've all been hearing about the US deficit and the political situation over there. And this has in turn pushed the yields up. I think the 30-year T-bill is at around 5% now, and it's added a lot of pressure on the liquidity side of things. So to me, it looks like regulators are trying to offset the downgrade's impact with on the market utility by easing these capital rules, which will make it easier for the banks to set in and smooth out the volatility that's happening in the treasury market. So they've sort of got counteracting impacts. But I guess with this and everything, there is going to be a trade-off to cutting these capital requirements because there's going to be more liquidity, which is going to lead to a more stable bond market. But the lower capital requirements are going to leave these banks exposed with smaller buffers, which could increase systematic risk across all the banks. And if we were to see things like under the COVID crisis, stuff like that, it's gonna be a massive impact if they've not got the liquidity themselves to handle all of this. So I guess at the end of the day, it is a balancing act.
That's going to be interesting. Definitely a funny way to deal with volatility and uncertainty. And to me, I've been fascinated by the concept of black swans and how there are supposed to be, weird events that might happen once in a blue moon, but they seem to be more common. Like honestly, if today an alien just fall from the sky, just say hello, would you like coffee? I wouldn't be that shocked. Um, there is a lot of weird stuff happening at the moment. So I don't know. I feel that the what you're saying is very valid. It will add liquidity to the market, to their books and decrease deficit. But what happens if another, as what you were saying, one of those weird events happens again?
Who knows? Black swans is a really, really interesting area of research.
Hmm.
It's one that I like as well, a lot. But if these banks don't have the liquidity behind them and all of these, customers are looking to
Get
take
their money.
withdraw money, for example, yeah, then they're going to need to be bailed out somehow. They're going to have to sell assets. It's going to be chaos.
I know. And I think a good takeaway from this interview is chaos is going to come regardless of what you do. It is unavoidable, but a good way to deal with it is just to know what to do in bear, base, bullish, extra bearish, dead afterlife case, and be as forward looking as possible.
Completely agree.
Awesome. This has been great, James. Thank you so much. You're so knowledgeable. So smart. Thank you very much for your time.
Thank you for having me. It's been a pleasure.